Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between a half and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, bit more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'd be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much of it happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment, and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that, very important.
Nick.
Nick Timoros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers, on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system, so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So. And so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable. And, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So We look at that, we see it, we get it, and I mean, everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless, it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years, for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of, you know, of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that you know, we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were like discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But so sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there is tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's, you know, 1 percentage point above that. So calling that stagflation, it's not, you know, I would reserve the term stagflation for, you know, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and that's, I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case, we're going to learn a lot because we're going to learn 6 weeks to the day till the next meeting. And, we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing, as our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. You know, it's your opinion at a moment in time, which can change based on events. You know, sometimes very quickly. So it never locks people in. You know, people are more than happy to be proven wrong in either direction. And so I just think we do it. And you know, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But you know, we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, you know, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and you know there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and you know what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned and whether or not it will drive up, the cost of food and other goods that really rely on it to
So
move
I think
across the
it's
country.
a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Good morning, members of the FOMC. Today's staff presentation reviews current macroeconomic conditions, forecasts and risks, and our policy recommendation. Data-dependent monetary policy involves taking stock of current developments in economic activity, inflation, the labor market, and financial conditions.
Let's start with economic activity, which remains resilient despite tariffs and policy uncertainty. Real GDP increased at a 3.8% annual rate in Q2, as strong consumer spending and fewer imports outweighed declines in investment and exports. Additionally, non-farm productivity increased 3.3%, consistent with elevated gains since 2023.
While AI-related capital expenditures have supported investment, growth remains broad-based. Real final sales to private domestic purchasers rose 2.9% in Q2, highlighting robust private sector demand. Additionally, consumer retail sales and expenditures both beat expectations at 0.6% in August, with broad gains since June. Consumer delinquency rates, which have been rising since 2024, appear to have peaked, while personal savings rates have been revised upwards, suggesting that the household balance sheet may be more resilient, a trend that could support future growth in consumer spending.
The business outlook remains uncertain. Consistent with Baker et al., continued policy uncertainty likely weighs on investment. However, regional manufacturing signals are trending upward from April low, supported by resilient AI CapEx across many industries and upcoming tax policy encouraging investment in 2026. The growth outlook remains strong. GDP now and nowcast project a Q3 growth of 3.9% and 2.3%. Uncertainty remains elevated, so we acknowledge a wider than usual band of forecasts.
Next, we turn to inflation, which remains elevated. In August, year-over-year PCE and core PCE rose 2.7% and 2.9% respectively, up 0.3 to 0.4 percentage points from the April lows. Similarly, year-over-year CPI and core CPI have risen to 3.0% in September. Recent upticks in inflation have been driven by several factors. First, goods prices, which were declining last year, have begun to rise, likely reflecting tariff-induced price pressures and the unwinding of prior overstocking by suppliers. In particular, tariff-exposed durables like consumer electronics and appliances have posted significant monthly gains. The Yale Budget Lab estimates that core goods and durables were 1.9 and 2.3 percentage points more expensive, respectively, than their pre-2025 estimated trends in June. And Cavallo et al. Estimate that tariffs have added 0.7 percentage points to the headline CPI in the 6 months ending in August.
Core services inflation remains sticky. The Dallas Fed estimates that, excluding imputed non-market prices such as portfolio management, core services PCE has steadily hovered around 3% since May 2024, driven by strong consumer demand and elevated labor costs. In particular, the 3-month average of median hourly wage growth was at a 4.1% annual rate in August, down from 2022 highs, but above pre-pandemic averages.
Shelter remains a key but lagged driver of inflation. Shelter CPI rose 3.6% year-over-year in September, down from 4.0% in April. However, the year-over-year Zillow rent index has already normalized to pre-pandemic levels. Ball & Co. argued that shelter CPI lags market rents because rents are smooth for lease renewals, most existing rents are set in long-term leases, and rent changes are measured every 6 months.
Distributionally, the New York Fed's economic heterogeneity indicators show that current inflation gaps have narrowed compared to 2021 to 2022. Additionally, Hispanic, Southern, rural, and middle-income households have all seen lower inflation than the national average.
We now turn to the labor market, which has been characterized by gradual cooling in both supply and demand. The U3 unemployment rate rose to 4.3% in August, the lowest level since 2021. Monthly non-farm payroll gains averaged 29,000 over the last 3 months before revision, well below the 12-month average of 118,000.
Labor demand has eased. Non-farm vacancies reached a 6-month low in July and a 10-month low in July, and the vacancy to unemployment ratio has declined to below 1 for the first time since April 2021. In addition, the hiring and quits rates are near historical lows. That being said, the recent rise in unemployment has been driven mostly by new entrants and re-entrants' difficulty finding jobs rather than existing workers being laid off. Businesses have slowed hiring, but appear to be largely retaining workers amid uncertainty.
Diminished job finding prospects have hit young and less educated workers hardest. Unemployment for 16 to 24-year-olds is up 1.5 percentage points since January, versus 0.2 for prime-age workers. And unemployment for workers with less than a high school diploma spiked to 6.7% in August. Moreover, Black workers saw the steepest year-over-year increase in unemployment in Q2.
Labor growth has also slowed. The LFPR slipped to 62.3% in August, and the employment-to-population ratio is at its lowest since 2022, though their prime-age components remain near historic highs. Slower immigration is also weighing on labor force growth. Net migration is expected to decline in 2025, and BLS data indicate a 1.1 million decrease in foreign-born workers since January. More broadly, marginally attached and discouraged worker counts have steadily risen. Overall, we see a low hiring, low firing environment with labor supply decreases and uncertainty weighing on the current softness.
Finally, we turn to financial conditions, which moderates the transmission of monetary policy into real activity. Broader conditions have loosened this year. After an initial spike in April, the Chicago Fed's National Financial Conditions Index now currently indicates that conditions are more than a half standard deviation looser than their historical average, driven largely by fallen risk premia. Additionally, the board's FCIG index now indicates that conditions are a tailwind to growth.
The percentage of domestic banks tightening their lending standard has slightly increased for large and mid-sized businesses in 2025, especially after a Q2 spike post-tariffs. While bank lending conditions have tightened, private credit continues to scale as a lending channel, totaling $1.3 trillion in mid-2024, more than twice its 2019 level. At the same time, the high-yield bond spread has narrowed by 150 basis points to 3%, below the historic average of 4.2%. As such, financing conditions remain loose, reducing the urgency for lower rates to support lending. However, the dollar has depreciated 8% year-to-date, while the gold has increased 45% year-to-date.
Looking at key rates, the yield on 10-year treasuries has declined more than 60 basis points since the beginning of the year to around 4%. Mortgage rates have also declined but remain elevated. The average 30-year fixed-rate mortgage dropped to below 6.3% in October. Commercial real estate risk has slightly moderated given high recent transaction prices and elevated occupancy rates. At the same time, equity markets remain exceptionally strong, with the S&P 500 index repeatedly reaching record highs.
We now turn to forecasts and our weighing of the risks of inflationary persistence against further labor market weakness. Inflation risk is sustained by continued tariff pressures, sticky service prices, and potential de-anchoring of expectations.
First, tariff pass-through remains incomplete. Cavallo et al. Estimate that tariffs pass-through to consumers is currently 20%. Boston Fed research suggests importers plan to pass through about two-thirds of production cost increases. Compared with 2018, tariff pass-through is likely slower due to policy uncertainty and larger inventory buffers. Additional tariffs could further elevate inflation risks.
Tariff pass-through appears to be affecting non-importers as well. Cavallo et al. Show that non-importer sectors' prices have risen to match affected sectors, suggesting that firms are either raising their markups due to newfound pricing power or are passing along elevated input costs to the consumer. Additionally, the BLS Import Price Index has only slightly risen since April, suggesting that foreign firms have yet to meaningfully absorb the cost of tariffs. Though tariffs' effects on inflation can be transitory, Kuboborda et al. Find that they can persist when intermediate inputs are affected.
Second, non-housing services inflation, covering half of consumer spending, remains high at 3.3% with little sign of decline. This is consistent with sticky wage growth still above the pre-pandemic level. With strong wage gains and upcoming fiscal stimulus ahead, upward pressure will likely persist next quarter.
Third, inflation expectations risk becoming de-anchored. Surveys from the University of Michigan, the Cleveland Fed, and the New York Fed all report one-year consumer expectations that have significantly increased. That being said, longer-term market expectations remain closer to target, with five-year break-even inflation hovering around 2.4%.
We now turn to the employment mandate. First, labor market weakening may accelerate. Job gains have been concentrated in a few sectors, mainly private education and healthcare. Excluding the latter, monthly non-farm payroll gains have been negative in 3 of the last 4 months.
Furthermore, with historically low hiring, any increase in layoffs can have outsized effects. Indeed, the beverage curve has moved down since 2022, so further vacancy declines could raise unemployment more sharply. Worker expectations have also worsened. The New York Fed estimates that the mean perceived probability of finding a new job if laid off is currently 47.4%, near pandemic lows.
Second, retaliatory tariffs or potential new export restrictions, such as recently proposed tariffs on steel by the EU, could further hurt U.S. exports. Third, Londono et al. Find that inflation uncertainty itself is associated with precautionary behavior that weighs on investment and demand.
However, there are 2 factors that temper our view. First, economic growth and consumer spending remain resilient, and wage growth is stable, suggesting that the recent payroll softness may partly reflect supply-side factors such as immigration outflows. Recent research by the Dallas Fed suggests that break-even employment decreased to around 30,000 in mid-2025, dramatically lower than the peak of 250,000 in October 2023.
Second, Nugent and Silla note that firms tend to reduce job postings during periods of elevated uncertainty, particularly for high-skilled, costly-to-reverse roles. Thus, current softening may reflect temporary uncertainty more so than structural weakness, and we may soon see labor market data align with relatively solid GDP readings.
We now turn to our policy recommendation. When weighing inflation against unemployment risks, policy errors are asymmetric. Over-tightening can generally be quickly reversed if the labor market deteriorates, but inflation de-anchoring and credibility loss from over-loosening are far harder to correct.
Thus, our recommendation is as follows. For the December FOMC meeting, we advise the committee to hold the target FFR at its current level of 3.75 to 4.0%. On the balance sheet, in line with the October decision, the committee should maintain the current size of the balance sheet while reinvesting principal payments from agency securities into treasury bills. Regarding a communication strategy, the committee should communicate a data-dependent approach incorporating labor markets development.
We prefer holding to cutting for 4 reasons. First, the risk of inflationary persistence remains salient. Core services PCE remains above target, and continued tariff pass-through could keep price pressures elevated for longer.
Second, expansionary fiscal policy, asset price increases, and concerns over the Fed independence have also led to more sensitive expectations. Given perception of the committee's delayed response to pandemic-era inflation, a serial error in timing current inflation may de-anchor expectation and significantly damage credibility. Recent research by Nakamura et al. Suggests that only highly credit central bank with long records of stable inflation can afford to look through temporary inflationary shocks.
Third, the unemployment rate remains near historical lows. Some of the recent softening reflects supply-side shocks, and a resilient economy continues to provide support. Moreover, high-frequency labor market indicators haven't seriously deteriorated since August. For example, the Chicago Fed's nowcast puts the unemployment rate at 4.35% in October, the layoffs rate up 0.01 percentage points, and, with initial and continuing claims, largely steady. As such, we believe that the risks to the labor market currently outweigh inflation risk and credibility risk.
Finally, it is debatable how restrictive policy is at 3.75 to 4%. While the SEP places R* near 1%, other estimates hover around 1.5 and 2%. Post-pandemic factors, sizable fiscal spending, smaller trade deficits, AI-driven investment, and wealth effects likely have raised R*. Furthermore, loose financial conditions and robust growth further suggests that rates may be closer to neutral. An additional cut could be unduly stimulative given persistent inflation risks.
We agree with the committee's October decision to cease balance sheet runoff. The ONRP has fallen to $14 billion from a $2 trillion peak. The EFFR IRB spread has narrowed, and standing repo usage has increased, all signs that liquidity pressures are building. To limit intervention in mortgage markets, the committee should continue replacing agency MBS with treasury bills on the balance sheet.
Beyond the December meeting, there are 3 facets of the economy that we recommend the committee pay close attention to. First, the committee should be particularly sensitive to JOLTS and claims data that suggest that firms are moving from a great stay towards active workforce cuts.
Second, inflation and its components should be closely monitored. Greater tariff pass-through, lasting input prices increases, or stickier services inflation could suggest that policy rates should stay higher for longer.
Finally, if both inflation and employment seriously deteriorate, we may find ourselves at risk of stagflation. While the committee should carefully weigh both sides of its dual mandate, we believe it should be especially cognizant of the high cost of potentially having to re-anchor inflation expectations.
In conclusion, while both inflation and unemployment risks remain, the current situation favors holding rates steady. Thank you. We look forward to your questions.
Thank you for your presentation. We have a couple questions for you. First, we've seen monthly job gains move sharply lower this year relative to last year's period, while at the same time, the unemployment rate has only moved up a bit. How are these observations consistent, and what are the implications for monetary policy?
Yeah, thank you for the question. So as you mentioned, the non-farm payroll number decreased a lot, but the unemployment rate rose slightly a little bit. So firstly, I will touch on why the non-farm payroll numbers decrease is lesser concern than we thought it would be. There are 2 temporary reasons. Firstly, we have seen immigration outflow. We have seen immigration net outflows around 1 million less than what we had before. And that may imply that supply side factor, we need less jobs to keep the unemployment rate at a steady level. And second, we also seen that LFPR has a historic trend of trending down post-pandemic. We have seen that after the pandemic, the older people LFPR has decreased. A lot of the people choose to leave the employment markets after the shift.
Yeah, and I'll also add that There's been a lot of questions about the validity or sort of accuracy of jobs data recently. So we had a recent paper by Becker et al. In 2024 that talked a little bit about how, the births deaths model is kind of 1/3 of what we're sort of using to impute for job gains over, the past few years. And it's even increased closer to 2/3 recently. And so a lot of, the model itself, we've kind of had lowering response rates, especially for new firms who are kind of further relying on the births deaths model. And so as a result, these numbers have potentially become a little bit more volatile in addition to sort of this decrease in the break-even rate that's driven primarily by labor supply factors.
Yeah, and I will also make a very quick point that there's research by Bloom et al., which shows that after periods of high uncertainty, the labor markets tend to rebound very quickly. So that's another reason why we tend to be a bit less worried about the labor market right now.
And the final thing I would add, just to update for the September jobs report, is that most recently we saw monthly non-farm payroll gains at 117,000 in September. And so that would imply that perhaps payroll gains could be trending upwards. It does also mean that with regards to the break-even rate, though, that despite the increase in 117,000 jobs, we did see unemployment still tick up by 0.1% to 4.4%. When we're looking at the data, we see a decrease in the marginally attached workers, which we mentioned in our advocacy as trending upwards. We saw a decrease of around 400,000 and a corresponding increase of 0.1% in the labor force participation rate, which could imply that the one way to interpret the data would just be that we see a greater labor force participation. So we would say that to put it all together, we think break-even has definitely come down from where it has been post-pandemic from around 200,000. It probably could be a little bit higher than the 30,000 estimate from the Dallas Fed, but is probably somewhere in between there.
Yeah, and I'll very, very quickly add to your last part of the question in terms of implications for the Fed. If we think this is primarily a labor supply driven softness in the labor market, then you can imagine that the Fed's sort of monetary policy that primarily works through the labor demand channel will be generally less effective. So that itself sort of makes us a little bit more worried about how significant cutting will do in terms of stimulating the labor market.
Thank you. We're going to shift to financial conditions. How should policymakers take into account signals from financial markets, such as stock valuations and credit spreads, when deciding on the appropriate stance of policy? And this is a two-part question. Second part, if changes in financial markets have different implications for monetary policy and financial stability, how should policymakers weigh the trade-offs?
Yeah, thank you for the question. So for the first part of your question, we think that central banks should take into financial condition only insofar that it affects our dual mandates. We do think that financial stability is a prerequisite to achieve this dual mandate. So to put in context of our current situation, we are saying that stock valuation is really high, and we shouldn't think about we should pay less focus on whether this is actually overvalued or undervalued. What we should pay focus to is that the stock market is probably an input to aggregate demand, because when people's wealth are up, they tend to spend more. And that's general robustness in the aggregate demand may mean that inflation is likely to stay higher for longer and labor may rebound.
Yeah, and so I'll add, kind of build off of that. There's been sort of a debate in terms of whether the Fed should lean against the wind. There's papers out there talking about predictable financial crises. This was Greenwood et al. Sort of talking about how you can sort of predict a financial crisis. And now the question is, when we think that asset price valuations are kind of ballooning, should we lean against the wind? So Svensson 2017 talks a little bit about two channels of why leaning against the wind may sort of be a problem. So one, you can imagine that if we lean against the wind and there isn't actually a bubble, which is sort of unclear right now since it's sort of early in sort of the AI boom currently, you can imagine that economic growth will be lower than it otherwise would have been. On the other hand, you could also imagine that given the long and variable lags in monetary policy, if you sort of hike now to try to prick the bubble and the bubble bursts very soon, then the contractionary effects of this hike might hit you when the economy needs to necessarily be kind of expansionary. So as a result, what Svensson finds is that you would actually need a hike in the rate to actually be 5 to 40 standard deviations higher in terms of reducing the probability of a crisis than current literature estimates. So we, as a team, sort of don't really move towards this idea of leaning against the wind currently.
Finally, I'll just touch on kind of two short points. The first is that I don't know if we've kind of seen a bifurcation in financial conditions in the sense that we've seen very resilient AI CapEx. We've seen a lot of private credit, and indeed, credit spreads are very tight. At the same time, I think mortgage rates are particularly elevated. I think consumer delinquencies for credit cards and auto loans have also increased, though they've stayed steady in the last couple of months. And so there is the sense where you can kind of interpret it in the sense that like policy might be like slightly restrictive, kind of because like rates that are being like encountered by like consumers as businesses are kind of high, but also in a sense that like some of the investment we've seen has also been occurring like despite the fact that like policy is restrictive, in the sense that we expect kind of the rate of return on like AI capex and like data centers to be like extremely high. The second thing that I'll also note is that it might be potentially that a decent amount of kind of investment or like loose borrowing is also an expectation of kind of like future rate cuts. Like if we think that a lot of borrowing right now predicated on long rates bakes in kind of expectations of the path of rate cuts, then one implication we might have for the Fed is that if we were to embark, for example, on contractionary policy, if we were to say, okay, we're going to focus completely on inflation, that might kind of like, it might be like a shock to kind of our path of expectations. And so generally, we don't necessarily think that the committee should make decisions basically completely in line with market expectations. We think it definitely has to prioritize the dual mandate, like my colleague Yafen mentioned, but we do have to be cognizant of the fact that moving in the opposite direction of market expectations might significantly change people's kind of investment, lending and borrowing decisions.
Yeah, and to address very quickly the second part of the question on how should the Fed think about financial stability in terms of policy, we think that the Fed should be very predictable in the way it conducts monetary policy. And so on that note, balance sheet management becomes very important. We saw examples in the past, like in 2013, the taper tantrum, or in 2019, where the Fed let run off a bunch of securities, and that sort of freaked out the markets. And so the Fed had to later step back in to purchase new securities in order to rebring stability into the market. So we think that the most important thing is that the Fed conducts monetary policy and especially balance sheet management in a very predictable way. And that's why we advocate in our presentation for stopping the runoff of securities in the balance sheet of the Fed.
Thank you. I would like to follow up on this last answer you gave on something that interests me very much about the balance sheet policy. Can you explain me or elaborate further on which pieces of data have led you to your current recommendation of holding the balance sheet purchases? Yeah. And then what would you need to see, what changes on the data do you need to see in order to change your recommendation?
Sure, yeah. I think my colleague wants to add something, yeah.
Sure, so I can start off on this. So in May of 2022, the committee decided that it would begin its policy of quantitative tightening, i.e. running off and decreasing the size of its balance sheet. The reason for this is to kind of